Thank you, Dave, and good morning, everybody. It is a pleasure to be with you and excited to kick right into it here and talk about options trading. In fact, low cost weekly options. Want to actually get some feedback from you as we get things rolling. How many of you are trading options or not? If you're new to options, don't worry, we'll get you covered. But type a number in. If you're brand new to options, type a 0. Never traded before. Traded for 20 years, type a 20. I love to know what kind of experience level we have in our crowd with us today. And really what we get is an opportunity here to talk about how to leverage your capital, but still do it in a very risk managed way. Okay, so new to options, don't sweat it. We're going to get into that and definitely cover you there. So definitely don't. I never name names, put anybody on the spot on these little polls that I like to do, but just we might have some folks who haven't traded options before. You're still in the right place here. So let's get right into it and remind you as we do that the information that we share with you in today's presentation is based on our proprietary research and it's intended for illustrative purposes only. What we're talking about here should not be considered specific advisory recommendations. As you know, stock and options trading have large potential rewards, but they also have large potential risk. The past performance of any trading system or method is not necessarily indicative of its future results. Do see our terms of use on the bigtrends.com homepage for more information. And we got a 10-year veteran in with us as well, so and so different experience levels. So glad to have each and every one of you with us. So what we're talking about today is a way to kind of get the best of both worlds in terms of options trading. You know, a lot of people try to get started with options buying and then they don't do it the right way, and then they think, well, it must be a seller's market. The reality of options trading is it's the proverbial zero-sum game. There's winners on both sides, buying and selling options, depending on the move or the lack of a move that you get. What we're focused on here is how can we get your risk capital back faster, which will actually allow you to say, get your risk capital back faster, still keep part of your money on the table for the bigger runners, kind of a hybrid approach, right? You can thus have a higher win rate than you're used to buying options when you take part of your profits off to get your risk capital back, get to the proverbial free trade, and then still have a high reward kicker or runner, as we call it, on the rest of your trade that can turn into a multi-100% winner on the final piece. And so, of course, there's going to be risks. There's going to be trades that hit stop losses, and we're going to talk about both sides of the equation here. You've always got to look at both sides of the coin in your trading strategy to be effective. I am a believer in systems. I'm a believer that if you don't have a method to the madness that you can execute consistently, then you're going to be lost. You're going to be constantly in reactive mode. So my view is that, sure, the markets change, the names change, but we will tend to find new trends and new opportunities in different sectors. We've seen a rotation kind of away from tech in recent months, and yet you still have a ton of other sectors that are benefiting in terms of financials, in terms of industrials, in terms of just a variety of growth names that are still ripping in today's markets. I think it's going to be that momentum market for quite a while to come, looking into 2025 and beyond, with our incoming president inauguration in mid-January. You're going to see a lot of news flow, a lot of things that are driving trends up and down in 2025. You want to be prepared to take advantage of both. We'll give you a bunch of chart examples, success stories, and we call this our T3O or triple three option strategy here. And so we're going to get into the details on that. If you don't know me, I've been trading options for 35 years and counting. Launched Big Trends just over 25 years ago, November of 99, just had our full 25th year anniversary, and blessed to have served tens of thousands of traders all over the globe with systematic, repeatable approaches that you can continue to execute. In these cases, what I'm sharing with you is we do call out the trades from the system. We teach you the system when you become a subscriber, but you do get trade alerts. You do get real-time updates. You're never left hanging with what I'm going to share with you. We tell you when to get in, when to get out, but you can ultimately learn how to do it yourself, kind of following along with regular training that I give you as part of the trade alert system here. So let's kick off today's event with a winning trade example from Apple earlier this year. And this is one that we called out here back in August. Apple had been rising up. It's rising again today, at least earlier it was, based on news that they were integrating their AI features in with their Siri voice recognition assistant. So it's really interesting times, right, with all the AI news that's hitting in all these companies. But this is a case where, we look for a kind of a combination of things that happen in our triple three option strategy. First things that have to happen is it's made a new recent high. So as it was rallying up, we weren't getting into it until it starts to make a new high over the prior bar, and it had given us a couple of gaps up. Now, in this case, this is a daily chart, daily candles. Candle never makes a trend for me. I'm looking for multiple days of setup here to tell me that we're in the right kind of setup. So we get in the end of the day here with a stock around or just under 225. We called out to buy in the last hour of the trading day there to buy the slightly out of the money, about 1% out of the money, the 227.5 call. So for those who are new to options, a call, of course, is a right to own the stock at a fixed price here, the strike price of 227.5. And you say, well, why would I buy that when it's already down at 225? That's an out of the money option. It's got a little over a week of time. We buy the following Friday, the August 30th expiration, in this case, the week 5 of August, Friday expiration. So point being that we're buying it there and we're betting it's going to rally. Now, the key here is that we're never all or nothing with this strategy. We're basically saying, look, our first objective is to get risk capital that you put up for the trade. In this case, we're saying, say you put $1,000 in at maximum on every trade. Well, that would allow you, when we purchase each option contract, costs us $1.81 or $181 on each contract, controlling 100 shares of stock. As you know, 100 shares of stock here would cost you about 22.5 grand. You're controlling that for under $200, $181 for each of those contracts. So if you're buying $1,000 worth, you can get up to 5 of those contracts times 181 a piece, gets you in for like $905 total. These examples are all before commissions, but commissions won't cost you more than $1 in and $1 out per contract. So 5 contracts in, $5 commission at most. And as you get more active, you can reduce that. So point being that, okay, you're in for 5 of these. How do I get my risk capital back? Usually my goal is to sell 2/3 of my position at a 50% gain. In this case, I've got to sell a little bit more than that, because 3 contracts out of 5 would only be 60% of the position. We sell 4 of the 5 contracts, 80% of our position, when it gets to a 50% gain, which you see happens the very next day when it tests up to the old highs, right? It rallies back up to 228 that next trading day. So we're selling out of the majority of our position, 2/3 or more of our position, and yet we're still keeping something on for the runner. The runner is held, in this case, the final contract is held for 5 trading days. Okay, so we're getting in with in these trades with at least a week before the expiration, anywhere between 6 and 10 trading days before the expiration. And you're saying, okay, look, we're buying. We still have 1 contract left. We bought it for $1.81. On the 5th day, it gets up here at about 232.5. What's it worth at 232.5? You have a right to own it at 227.5. At 232.5, right before the expiration, it's worth at least $5. In fact, that's what we got out for, is $5 that afternoon, the day before the expiration. So the beauty of this is you say, okay, we made 50% of the first piece. Our last piece, the runner piece, in this example, made us more than 3 times that. It made us 176%. That was still on only 20% of our original position, right? So, of course, that trade made us $181 to $500, made us $319 on that last contract, almost half of our total profit on the trade for just a minority, 20% of our total position. Point being, made $683 on $905 invested. Of course, every situation's different. You're going to have trades. The next Apple trade we get could be a loss. It could be a bigger win than this. In fact, we had one that was on near 1,000% on the final runner piece earlier in the year, a 10-bagger basically on the final piece back in June when we had the AI surge. Hopefully got that chart in here. But point being that win, lose, or draw, you know that we're in this to get your risk capital back faster. What that does is it frees you up, not just financially, but psychologically, to let the rest of that runner run for the 5 days, right? So the goal being that don't get shaken out, don't get nervous about your trade. Once you've gotten your risk capital back, in this case, we got more than our risk capital back. We sold 4 of those contracts for more than $250 a piece, more than $1,000 total. It's like $1,088 back. So we're already up on the trade by like $175 or so, right? So $180. So the point being that, okay, that's a nice place to be. Then you can let it run. That will quit you being so antsy. I see way too many traders who are not holding their winners long enough, that are getting antsy about a winner turning into a loser. So they say, oh, you can't go broke taking a profit, right? But the idea is that, if you take small gains and bigger losses, you're going to have problems. So the goal is, we want to flip that script, get you into some bigger gainers with still manageable risk. So we're going to hold these about up to a week, no more than a week, on the winners that run. Our price action methodology, looking for that momentum. It's made recent new highs, and it's been showing multiple gaps up for bullish trades. Can be multiple gaps down for bearish action with recent new lows. That can be a put trade. So the bottom line is that we can get both calls and puts here. We're just buying options. We're not doing any spreads, keeping it really simple. We can have up to 10 new trades a month. We say expect about 8 trades a month on average. We can get up to about 10, but about 2 a week is our goal. But the win rate, and you say greater than 50%, that doesn't sound that exciting. But when you buy options, normally, especially at or out of the money options where they're all time value, with no edge, you would expect to have a win rate well below 50%, because you're going to have time erosion. So we need to have that trend advantage, and the taking profits on getting our risk capital back on the first 2/3 of our position or more. That means that whatever we sell the remainder on is going to allow us to show what our gain will be based on that remainder follow through. So the idea of this is that will boost your win rate. It's not just though about having a high win rate. It's also about having a bigger size of win compared to your size of loss. And so we'll look at some more examples of that. Also, we're not just focused on a lot of trades. We're focused on having high quality trades based on the look back period for us is the last 10 years. That doesn't guarantee the future. The future results are never guaranteed. Future results are going to vary. But the idea is that when you have, I believe that stocks are a lot like people. That some stocks are predictable in their steadier patterns, or some are more volatile up and down and less predictable. And so again, there's never perfect predictability, but the idea is that you will see patterns, and the stocks that have shown us predictable patterns over a 10-year look back through bull, bear, and sideways periods are going to be ones that we want to trade on for that opportunity going forward. Because while we can't guarantee any one trade, we can look for that more reliable pattern as something that we can feel better about investing in, and still managing risk on every trade, no matter how well it's done in the past. So we're going to get in on a Monday through a Thursday in that final 30 to 45 minutes of a trading day, Wall Street time, 3:15 to 3:30 p.m., just under an hour before the close. We'll get up to and no more than 4 trades open at any one time, so you're never overcommitted. And the other beautiful thing about this is that you're not going to have any day trades here, because we're going to get in that last 30 or so minutes of the trading day, and therefore our first exit could be as early as the next morning, but not the same day. So our maximum, though, is we will not hold it past 5 trading days. And we don't just wait to the very end of the trading day, just because we don't want to cut it too close to a volatile end of day kind of activity. So we get out at 1:30 p.m. on the 5th day on those runners if they haven't hit their trailing stop before then. So why should you care? When you look at history going back on all trades, we call it out win, lose, and draw. Remembering that, of course, past performance never guarantees future results. Go back to the beginning of last year through yesterday's close, and all closed trades, you can see up $9,452 gross. That's gross profit, including all winners and losers, but it's before commissions and before subscription investment. This assumes that you never grow your amount invested per trade, right? So if you start off with a $5,000 trading account, you start out putting $1,000 maximum per trade. Even as you've almost tripled it, you're still using the $1,000 a trade on the next trade we call out. So we're not compounding our capital into a trade. I believe that will help you to keep more of your hard-earned capital. It doesn't necessarily maximize the potential run-up phase, but it does also help you to minimize the drawdown risk compared to those who keep leveraging their amount as they grow their account. That'll almost guarantee that when you do get a drawdown, you'll feel it more if you're leveraging your amount invested based on how much your portfolio has run up. So we like the fixed dollar commitment over time to not have such a drawdown hit when you do get some give back on a few trades. Now, so let's get into the steps that we look for here. The filters we use are, we're looking for multiple consecutive gaps in, say, the upside direction for a bull trade, and that we've seen a recent new high on that bullish setup. So with this, and for the bearish setup, it's the opposite, right? We want to see this making new lows. and that is continuing that gapping down price action in recent bars to show us that there's a lot of selling pressure. I haven't seen much of that lately. So we've had more calls and puts lately. That's fine. You want to be aligned with where the market is telling you that it's going for these major stocks that we're trading. These are definitely the more active stocks and stock options. We're not dealing with stuff that that trades by appointment. It's not never going to be us against the market maker. It's us against a lot of other options traders. So we use the simple moving average filter on bearish trades to make sure we're not fighting trend momentum. And then we do look at that 10-year look back to say, okay, how's it worked for when we get a bull signal, these buy signals. So when we buy calls, has this worked over time fairly consistently, or has it been more erratic? The erratic ones we'd pass on. We're looking for a meaningfully profit factor, a meaningful one, showing us a good win rate and a good gain when it's right, and not too much pain when it's wrong. So like we said, new trades can trigger on a Monday afternoon or Tuesday or Wednesday or Thursday afternoons, any of those afternoons in the last hour. We don't take new trades on Fridays because when we're going out to the next Friday's expiration, the 5-day kind of follow through would have us exiting on the expiration day. We feel like that's cutting it a little too close for options traders. We never want to make you sweat about if you're worried that it's getting too close to the expiration. You won't have to do that here. And we guide you on every, not just entry, but every exit. So, and my analyst team and I are always available too, with a dedicated email you get as a subscriber to say, okay, I'm not sure what to do here. So we remind you if you haven't seen our email and our text alerts, we'll remind you what you need to do. If you have any questions, we'll validate that, what we send out to all subscribers. So the reason we call it 333 options is that we want you buying at least 3 contracts. If you're putting in $1,000, they will pay no more than $3.33 for each of the 3 contracts, because that way, if you got $1,000 invested, you can get at least 3 contracts at $3.33 or less. The Apple example I showed you earlier was $1.81, so we got like 5 contracts. We use ATR to select strikes. What does that mean? ATR stands for average true range. Basically, it's looking at the high-low range for any given stock and also factors in gaps, and basically gives you a volatility measure. Of course, a more volatile stock's going to have a wider set of ranges that we average out, and so that's going to help us to set what we need to expect about how much it should move to get us to our first target of 50%. Get your 2/3 of your position exited and or more, and then basically let the rest run. We call it set and forget it, stops and targets. It makes it really easy if you're a busy trader, you're working a day job, you want to do some other things during the trading day. The beauty of this is you don't have to screen watch. We'll call them out for you real time via email and text alert, so you can really take advantage of that. Now, the bottom line is that you look at an example here where say we're buying 3 contracts and we want to sell 2/3 of the first target level. Let's look at that. Say it was costing us $300 for each option contract you purchased. That means you can get 3 of them in for $900 total. Okay, $900 of risk. We all know, but if you're new to options, make sure you know that, hey, if you buy an option and at the money or out of the money option, nothing happens and you do nothing, the risk is that you could lose the full amount that you invested in any options purchase. That's a reality that could happen if you're passive. And if you get some big gap against you, it could happen even if you're proactive, right? It can happen. That's why we always tell people that while it's rare, we say, look, never load up on any one trade, right? Once you're spreading yourself out across plenty of different ideas here. So what's our objective? Well, when we can get to a 50% gain, say you invested $900, 50% gain means you'd be up to like $1,350. Each option contract's gone from $300 to $450 a piece. So now you're like, okay, well, I've got 3 contracts. I'm going to sell 2 of those at $450 a piece, up 50%. On the total position, and I get my original, and you get your original $900 back. We sell 2 of those 3 contracts at $450 a piece. So now you got the runner, you got the 1 contract left. It's still worth $450, and now you're saying, okay, I'm trying to let that run over the next 5 days. Sometimes it'll go on to something a lot bigger. Sometimes it'll tank, and basically you end up only breaking even on a trade if that last contract craps out on you. Okay, that can happen too. But you're giving it that chance to say, look, we've got the theoretically unlimited upside of options working for us. Typically, my experience is when we're right, we tend to stay right longer than you and I would expect. When we're wrong, we tend to stay wrong. That's just kind of makes sense, right? The markets kind of validate that a stock is doing what it should be doing or not, and everybody's feeling that pain or that gain. And you know how a trade is when it's working, it's like nobody's feeling any pain. Oftentimes that can be the ones that keep on pouring it on. The only people feeling pain are the ones who are fighting that trend, right? And it's ironic how many people will still be fighting a trend and then having to buy that back at even higher prices if they were shorting the stock on an uptrend, right? So let's look at some examples. Here's an example of exactly the kind of name I love to trade with this 333 option system. And it's Philip Morris, PM, the tobacco giant. And you can see here that one of the beauties about, say, a Philip Morris is that compared to, say, your typical tech stock, is that people assume a tech stock's got a lot of potential to move, so those options are more expensive. But with Philip Morris, they're not that expensive. They assume it's not going to have that big of a move. It's a slow, steady business. But it's certainly not a slow, steady trend here. Look, we get our breakout signal. We've been seeing positive gaps, got a really big gap here. You see it's finishing here that last hour around 109.5. We buy about 1% or just over 1% out of the money by the 111 calls going out to the following Friday, the first week of August. And so you can see here that we're buying those calls for 80 cents a piece, right? Less than 1% of the stock cost, right? $80 to control each 100 shares. It would have cost you almost 11 grand a piece, right? We're able to get 12 contracts controlling 1,200 shares, or something like about $130,000 worth of stock. We're controlling that for a total investment of $960. So you can see your leverage here is theoretically well over 100 to 1. But the idea is that, that's not why we play the game. We played the game to say, look, we want to get to a risk-free position. The next day when it rips up here and retests that prior day's high, we're right back to the strike price of 111. Our options have gone up on that more than 1 point move. They've gone up 40 cents, right? That's not a huge move, but in percentage terms, that's healthy, right? 50% gain the next trading day. So what do? You got 12 contracts, you sell 80 or 12, that's 2/3 of your position, and you do the math, 2/3 of your position out at a 50% gain basically gets you to a risk-free position on the remaining 4 contracts. So if the other 4 contracts crapped out, you still essentially break even on the whole trade. We don't want that to happen, but what we see a lot of traders do is they take their profits too quickly on the whole thing. This is, instead of being all black or white about your trading, I believe it's good to have kind of a shades of gray mentality of saying, look, we've done first objective, gotten your risk capital back. The second objective, though, is give it a chance to grow into something much bigger. And this one does. You see, it just keeps on ripping to the upside. And by the fifth afternoon, we're finishing here not far from 115, right? At 115, these options are worth $4. High there's like 114.83, so they're worth like 483. I'm sorry, 383 is the maximum intrinsic value. We get out at 340 that afternoon and end up taking a 325% gain on the second piece. Think about it another way. You sold 8 of your 12 contracts at up $40 per contract, right? That'd be $320 you made on the first 8 contracts. Look what you make on the last 4. You paid $80 per contract. You're getting out at $340 a contract. You're making $260 on each of those contracts. 260 times 4, more than $1,000 gain, $1,040 of profit on the last 4 contracts. The last 30 of your position makes you most of your total profit, right? 325% gain versus the original 50% gain. It's a great place to be. I know a lot of people will come back to me and say, man, I wish I'd held all 12 of my contracts. You can't think like that. I mean, again, for me, trading in the options game for 35 years, I would attribute part of my longevity to having sensible strategies that were never all in, all or nothing, never loading the boat on any one trade, just really looking at slow and steady, the turtle and the hare, right? The slow and steady turtle wins the race. The going too fast and then giving back too much on the next move, that's not what you want to do. You want to just be consistent in your capital allocation. So that's a really healthy return for 5 days of work, right? And so again, past performance never guarantees future results, but the idea is, how do we get more of those? I mentioned the Big Apple one this year, our biggest Apple gainer. And first of all, let me say, it amazes me that Apple can still move like this. It's the biggest stock. Obviously, Nvidia's had a great year too. Been vying with Apple for the title of biggest stock, but I think Apple has retaken that. They're close. But the point is, Apple's still moving like a speedboat, not a battleship. It's amazing. This is back in June. You can see we've been making those new highs. We've been showing those positive upward momentum, and then we say, okay, all of our conditions are checked when the stock finishes that day around 194. It doesn't have to show a pullback bar. We've seen a couple of those with Apple where it did, but that was happening on a Monday, June 10th. We bought the next Friday expiration, which was in this case, it was June 21st, the third Friday of the month. Those are called the monthly options. And the idea is that, but they're the third Friday in the month of June. So we've got, in this case, about 9 trading days left, maybe 8 with the June 6th, Juneteenth holiday in there, I guess. But bottom line is that you can see we weren't in that long, right? You can see we bought the 195 calls just slightly out of the money. We paid $222 a piece. Couldn't quite get 5 contracts, got 4 contracts. So we sell 3 of the 4, 75% of our position, when 222 turns into 333. Right? Because that $888 we're now getting out, 3 contracts at $333 a piece exit is $999. We're up $111, and we've got 1 contract remaining. Say 1 contract, what can that do for me? Look what 1 contract could have done for you. Is that when they announced the next morning that their AI stands for Apple Intelligence, and they're going to build Apple Intelligence into their new iPhone 16 later in the year, and they now have, well, you can see that that was the excitement of the stock ripping from the mid 190s. The very next day we're out of the first piece, but you see it rips all the way up the second day to 220. You say, oh, why don't you sell there? Well, we can't predict if it's going to 230, 240, 250. We just are giving it the 5 days. On day 5, you can see in the afternoon here we are finishing up in the neighborhood of 217, 218. And you can see we're out at $22.95. Think about that. We paid $222. It's now worth $2,295, more than $2,000 of profit, a 933% gain on just the final contract, right? Over $2,000 of profit is most of your profit in the whole trade on just the final single contract. So it just shows you how powerful even 1 contract can be. Obviously, that's an exceptional move. They're not all going to be that powerful. In fact, that's probably our best move of the year, right? So let's be clear about that. We've had multiple 100% winners, 300%, 500%. I think I had a Wells Fargo 700% plus. So it happens, right? So it's like those are the runners that carry your portfolio. Those are the ones that really make it worth doing the option trades. Deepak says, are these in the money or at the money? These are at the money to start on Apple, but usually even a little bit out of the money. That doesn't make me worried. It makes me basically say, just let's get our risk capital back quickly whenever we can, and let's manage it. How about a put example? Here's a put example with Wells Fargo where we triggered that. You can see the new low happening there, not by much, but it did trigger, and it had seen a couple of gaps downs in a row. Even though it showed a little reversal back up, we're saying into that afternoon right there, we want to get into these options with the stock trading about 43.8. We were buying the just slightly out of the money 43.5 puts. Remember, if you're new to options, a put is a right to sell the stock at that fixed price, the strike price of 43.5. So that right to sell gets more valuable as the stock drops. The very next day, it gaps down, and soon off the open, we're already down a couple percent in the stock down there, 43. We're cashing in 2/3 of our position. We got 15 contracts at 65 cents. 2/3 of our position exited at better than it. We had a 50% target, but right off the open, we ended up getting 86%. So we've assured ourselves a winning trade, even if the remaining 5 contracts go to zilch. You can see that we're getting in for $975. We're out of the first piece at $1,210, again, before commission. But the point being that 5 contracts left, we give it a chance to run. It does run a little bit the next day on day 2, right? We're making some more money, but then day 3 and 4 and even 5, it's kind of coming back up a little bit from the day 2 lows to the day 4 lows even, down. It got as low as almost 42.05, right? But the idea is that it finished about 42.5. And again, these options were worth about $1 intrinsically. There's a little bit of time left as well, so we get $1.14. We actually make a little less on the last third of our position. We only make 75% rather than 86% on the first piece. That just shows you the impact of the time, right? The stock was a little bit lower 5 days later than it was a day later, but yet the time erosion got to that one a little bit. It didn't go big enough to the downside. But we gave it a chance, and we had the ability with the free trade mentality to give it a chance, and still didn't get hurt really on still the final third of the position compared to the first 2/3. So as I mentioned, taking 2/3 off at 50% makes the trade risk-free. The free trade is one of the most powerful concepts, I believe, in options trading and options buying, because I see so many people who are skittish about their position and they take their profits too quickly. Now, here's a case with Delta Airlines where we thought it was going to take off. It started to take off, and then it came back down to earth a little too quickly here. So you can see here we're getting our breakout signal, getting in the final hour with a stock up here in the 63.5 zone. We're buying the 66 strike calls after the following Friday's expiration. And you can see here that when I get that first quick pop up here from 63, doesn't have to get to the strike price, but it almost gets to maybe 65.5, almost to the strike price. Our $1.07 that we paid a contract turns into a $1.61. We got 9 contracts on, so that is divisible by 3. So we get 2/3 out, 6 of our 9 out at a 50.5% profit. And now we've got 3 left. Gave it a chance to run. It did not run. By day 5, we said, okay, you know what? Let's take it out that afternoon at $1.08, basically a break even, 93 basis points, less than 1% gain. Call it a break even, but essentially, since you took the first half out up 50%, you make $327 on your original $963 investment, right? So that's the beauty of the shades of gray, taking partial profits and then giving it a chance. But if it doesn't run, you still turn that into a profit. If you just bought and held it for the 5 days and you break even, that's how you turn break evens into gains. There's a number of other examples where you'll see it could turn into a loss and you've already limited your risk. So bottom line is that if we can't take off exactly 2/3 of the trade, though, we will round it up. We will basically say, okay, in this case, we got 4 contracts on for Microsoft here in this end of day action near 427, bought the 430 calls, 4 of them on at 250, exactly $1,000 invested. We sell 3 of the contracts, 75% of the position, up 50% at 375. So that means we're making a slight profit, even if the last contract goes to nothing. That's what happens on this on the 5th day, or you can see it basically tanks. Our last contract is exited for just $10 a contract. That's a 96% loss. You say, oh no, you gave back your profit, but guess what? We still made money on the trade. The buy and holder over the 5 days, big problems, right? Getting a near wipeout, we make $135. We still make a little gain on the trade, even though the last position tank, the last contract just goes to near nothing. So that just shows you the power of taking the first 50% profit. What do you do on losses? We do take a stop loss if it gets down 50% without getting to our profit targets. Bank of America, we thought, hey, there's another example where we can really get a nice run in a bank stock to the upside. It only costs 38 cents, $38 a contract. We get a bunch of contracts. That's not the goal of this game, to get a bunch of contracts. The goal is to leverage whatever contracts you have to a 50% gain, get 2/3 or more of them off. This one does not fire. We get stopped out a few days later, down 52.6%. That's a $520 loss. It can happen. It will happen. So you have to prepare for that. But the big objective here is letting the final piece of the trade run without having a stop loss or a final profit target. The theoretically unlimited upside, once you've gotten to a free trade, has led to some massive gainers, like this example on Wells Fargo to the upside. So while Bank of America didn't fire, and this bank that did more than made up for it here. Wells Fargo, we called out the breakout. You can see when we got our breakout signal, stock's about 45.25. We buy just slightly out of the money, 45.5 calls. We paid 59 cents a piece, $59 per contract. Controlling each 100 shares gets us in for 16 contracts. So we have to sell 11 of those to get just over 2/3 of our position out when it gets to a 50% gain, which it does the next day as it keeps running. You see day 2, it kind of pauses. You go, uh-oh, what's happening? Is it gonna fade away here? And we're saying, hey, you've got a free trade on, give it a chance to run. Look at what happens on day 5. Day 5 is this last bar here. You can see it's up to about 50.5, which means our 45.5 calls are worth nearly 5. We get out at 485 that afternoon. That's a 722% gainer on the last piece. Look at the total profit on just under $1,000 invested, minus $2,460 in gross profit before commissions. Commissions round trip on 16 contracts in and out would have been a max of $32 total. So the idea is, look, more than $2,400 of profit for a 5-day hold. That's where it gets exciting, right? So how do you get these? We send these out as real-time trade alerts to you as a subscriber, but I'm constantly teaching you too. So we really believe in, again, 25 years and counting in the books for bigtrends.com. We really believe in learning while you earn. So we constantly give you support and education along the way of calling out the trade. So here's how you can get started and take advantage of this. I want the system to prove it to you. So I'm not going to tell you to go buy a year or more. I'm going to say, look, try it for the next 3 months. It's still a great sweet spot of time here as we push into the end of the year and look at the start of 2025 to allow you to try it for the next 90 days and say it's not a black box. You're going to get access to the settings and rules when you sign up for this 3-month trial to just basically let the system prove it to you that it's something you should be following for a long time to come. I'm also going to give you weekly video trainings. You're going to be able to see each Monday after the close. I get it posted usually by 6 p.m. Eastern time to say, okay, updating all my different alerts, and this is one of them. And I'll tell you what we traded, what worked, what didn't, and what we're thinking next about the markets here. You'll also get access to me and my analyst team via a separate dedicated email address if you've got any questions about your 333 options trades that we've called out for you. If you bought it off my website, it's $197 a month times 3. It's $591 you'd pay for a 3-month access. I'm marking it down. Scratch that $591 out. You're getting, in addition to getting all the educational resources too, I'm marking it down to $177. If you think about it, that means you're getting it for less than $2 per day over the next 90 days. $177 to try it out for the next 3 months or 90 days. Like I said, I expect to get in the neighborhood of about in 90 days, probably about 25 trades over the next 90 days. So you'll get a very representative sample over the next 90 days of how well this system can do for you. What I do ask new subscribers coming in is, part of the terms and services, you can't share this with anybody on the outside. This is just for you and your family's benefit. Keeps our edge strong for all of our fellow subscribers. But also, I say, you know what? Don't go whole hog and overcommit on any one trade. Start small. Prove to yourself that it works for you. Like I said, we want you to start with at least 3 contracts into each new trade, so that way you can get the 2/3 out at the first risk-free free trade opportunity, and then let the rest run. That's really the objective. So the page there is members.bigtrends.com/fest. Thank you to Dave and the Festival of Traders crew. Thanks for posting that as well. And then also just know that, remember, at $177, you say, well, is it worth it? Well, remember, what can one trade do for you? Obviously, there will be losing trades, but what can one winning trade do for you? A lot more than a losing trade can do against you. You can see you're limited in what you put, and your risk being what you put into a trade. You can see here your gain is potentially multiples of that. You put in this case, $888 into Apple. It turned into a $2,400 gross profit over 5 trading days. Quick look at our order page, and I'll hand it back over to Dave here just to remind you kind of how simple we keep things. I'm a big believer in the KISS principle in trading and in life. Keep it as simple as possible and no simpler, but keeping it simple really works well. We've already taken all discounts here, so no promo code to be applied. It's yours for the next 90 days for only $177. You just review the terms and conditions with your hyperlink there. Shows you how we've done business over 25 years in counting for our Big Trends community, and you'll be able to benefit for that now too, that you complete your purchase. You can call us if you have any questions too at our 800 Big Trends number, or you can email us through clientcare@bigtrends.com on that page. Also, PayPal is available there underneath that secure order page. If you want to put your credit card information there, great. But if you want to just do PayPal, I do PayPal on about everything I do online. It's so much easier. You can do it through PayPal there.